The bear case: dilution, differential risk, and execution hurdles. The bearish view on Cardinal Energy focuses on the risks associated with its capital-intensive growth strategy and the external volatility of the heavy oil market. 1. Shareholder dilution and equity overhang. The $104.7 million equity raise in February 2026, while prudent for the balance sheet, diluted existing shareholders at a price of $8.65 that many saw as undervaluation. Bears argue that Cardinal is forced to go to the equity markets because its dividend commitment, $117 million per year, consumes too much of its operating cash flow, leaving it unable to self-fund growth projects during periods of oil price volatility. This creates a dilution treadmill, where shareholders must constantly evaluate whether the growth from new projects will exceed the dilution used to fund them.
2. Widening WCS differentials and market access. Cardinal's increasing weighting toward heavy oil, 54% in 2026, makes it highly sensitive to the WCS-WTI differential. In early 2026, these differentials widened to the US $14 to $15 range due to concerns over Venezuelan heavy oil supply and US trade tariffs. If the differential stays wide, Cardinal's realized prices for its thermal production will suffer, potentially extending the payout period for REFRD 2 and straining the free cash flow needed to cover the dividend. 3. Execution risk on REFRD 2. The copy-and-paste strategy for REFRD 2 is sound in theory, but thermal projects are notoriously complex. Inflation in labor and materials, regulatory delays, or unforeseen reservoir heterogeneities could lead to budget overruns or delays in first steam. Given that Cardinal has already increased its 2026 budget to $160 million, there is very little margin for error if costs continue to rise.
4. High relative valuation multiples. On a price-to-earnings basis, Cardinal appears expensive compared to its peers. At 20.7x PE, it trades at a significant premium to Athabasca Oil, 10.2x, and Strathcona Resources, 5.9x. Bears argue that Cardinal stock is already priced for perfection, meaning any operational hiccup or commodity price dip could lead to a significant re-rating of the share price. The bull case: a transformation into a thermal powerhouse. The bullish thesis for Cardinal Energy is predicated on the transition of its asset base toward long-life, high-margin thermal production, supported by a stable conventional foundation. 1. Thermal execution and reservoir quality. The success of REFRD 1, delivered on budget, ahead of schedule, and exceeding nameplate capacity, is the strongest argument for Cardinal's future. The low SOR, less than 2.5, indicates that Cardinal has secured access to high-quality reservoir channels in Saskatchewan that rival the best SAGAD assets in the industry. If REFRD 2 and the subsequent Kelfield project achieve similar results, Cardinal will have effectively built a 20,000-plus BBLD thermal business from scratch in under 4 years.
2. High dividend yield and capital discipline. Cardinal offers one of the most compelling dividend yields in the Canadian energy space. Unlike some junior producers that cut dividends to fund growth, Cardinal has used equity markets to fund REFRD 2, preserving the monthly income for its retail-heavy shareholder base. The bull case argues that as REFRD 1 and 2 begin generating stable cash flow, the dividend will become increasingly safe, underpinned by assets with near-zero decline rates. 3. Valuation disconnect and FCF potential. Many analysts believe Cardinal is trading at a discount to its intrinsic value, reflecting the multi-decade cash flow potential of the thermal assets. Even more conservative targets from bank analysts suggest room for appreciation as the market gains confidence in the REFRD 2 construction timeline. 4. Strategic ESG advantages. Cardinal's Midal asset provides a unique ESG hedge. By sequestering more CO2 than it emits from all operations, Cardinal can market its production as carbon-advantaged or use its carbon credits to offset future industrial taxes.
Company overview. Cardinal Energy represents a case study in the maturation of the Canadian junior to mid-cap exploration and production sector. As of early 2026, the company is navigating a strategic transition, pivoting from a legacy model defined by low-decline conventional oil optimization toward a future anchored by long-life, capital-intensive thermal heavy oil assets. Cardinal Energy has historically distinguished itself through a commitment to maintaining a peer-leading corporate production decline rate of approximately 10%. This low decline profile is not merely an operational statistic, but serves as the financial bedrock for the company's shareholder return model. By minimizing the treadmill effect, the volume of capital required simply to offset natural reservoir depletion, Cardinal has historically generated high free cash flow margins relative to its production base. The company's conventional portfolio is diversified across 4 primary operating areas in Alberta and Saskatchewan, each providing a contribution to the corporate netback and inventory depth.
North Business Unit, Alberta. The North Unit focuses on light oil and natural gas liquids across the House Mountain, Mitsue, and Mica areas. Production here is characterized by high-quality light oil that fetches premium pricing relative to heavier blends. A significant driver of future value in the North is the Clearwater play, where Cardinal has acquired 69 net sections of land. The application of horizontal multilateral drilling technology in the Clearwater has transformed the economics of these assets. Vertical or single lateral wells, multilateral configurations maximize reservoir exposure per wellbore, significantly reducing the surface footprint and the cost per barrel of initial production. The central unit is a primary engine for medium-gravity oil production, particularly within the Manville Stack. The Wainwright and Chauvin areas are centerpieces of this unit, where Cardinal has identified over 100 potential drilling locations. The technical strategy here involves the systematic application of multilateral techniques to the Rex and Waseca formations. In 2024 and 2025, Cardinal leveraged learnings from successful ML wells in the Macklin channels to refine its 2026 development plan, emphasizing high initial productivity and sustained plateau periods.
South Business Unit, Alberta. Production in the South Unit is predominantly medium to heavy oil weighted, 80%. The core strategy revolves around the Ellerslie multilateral fairway expansion and rigorous waterflood management. Waterflooding is a critical secondary recovery mechanism for Cardinal. By injecting water into the reservoir to maintain pressure and sweep oil toward producing wells, the company effectively flattens the decline curve and increases the ultimate recovery factor of the asset. Saskatchewan Unit, Midale. The Midale asset is a unique operational and ESG asset. As a light oil enhanced oil recovery project, it utilizes CO2 injection to maintain production. This asset provides a dual benefit. It generates stable, high-margin light oil production and serves as a major carbon sequestration site. Cardinal has sequestered approximately 6 million tons of CO2 at Midale to date, with current rates reaching approximately 52,000 tons per quarter. This sequestration capacity provides a material hedge against rising industrial carbon taxes under Canada's output-based pricing system.
The Thermal Pivot, Reeford 1, and the Strategic Leap. The most significant catalyst in Cardinal's modern history is the successful execution of the Reeford 1 steam-assisted gravity drainage project in Saskatchewan. This project represents Cardinal's entry into thermal heavy oil, a move that fundamentally alters the company's risk and reward profile. Unlike conventional drilling, where production begins high and declines rapidly, SAGD production is characterized by high initial capital costs followed by decades of steady, low-decline production with very low maintenance capital. Operational performance of Reeford 1. Reeford 1 was delivered ahead of schedule and on budget, with first steam commencing on August 21, 2025. By January 2026, the facility had already exceeded its nameplate design capacity of 6,000 bbl per day, reaching volumes of 6,500 bbl per day. This outperformance is a critical indicator of reservoir quality and technical execution. One of the most important metrics for thermal projects is the steam-oil ratio, or SOR, which for Reeford 1 was reported at less than 2.5x. In the context of the WCSB, an SOR below 2.5 is considered elite, signaling efficient heat transfer and lower fuel gas requirements.
The financial implications of Reeford 1 are substantial. At a US $12.50 WCS differential, the project is expected to generate approximately $1.6 billion in cumulative free cash flow over its 20-year lifespan. This predictable cash flow stream is intended to provide the long-term funding for Cardinal's Dividend and future thermal projects. Reeford 2, the 2026 growth engine. In January 2026, Cardinal officially sanctioned the Reeford 2 project, located roughly 10 kilometers north of Reeford 1. Reeford 2 is designed as a direct copy and paste of the Reeford 1 facility, utilizing the same modular construction techniques and reservoir management strategies. The initial scope of Reeford 2 targets a base capacity of 4,250 bbl with an estimated capital cost of $140 million. However, the design allows for an expansion to 6,500 bbl for an incremental $40 million,
bringing the total potential project cost to $60. At 60 WTI, Cardinal estimates a project payout of approximately 2 years once nameplate capacity is reached.
Financial strategy. Cardinal's financial management is characterized by a delicate balance between the high capital requirements of thermal growth and the immediate demands of a high-yield dividend policy. The company remains committed to its $0.06 per share per month dividend, leading to an annual payout of $0.72 per share. The February 2026 equity offering. To fund the expansion of REFR 2 without significantly increasing debt, Cardinal entered into a bought deal equity offering in late January 2026. The offering, co-led by RBC Capital Markets and CIBC Capital Markets, was eventually upsized to gross proceeds of approximately $104.7 million. The common shares were priced at $8.65, representing a discount to the then prevailing market price. A nuance of this offering was its timing. The offering closed on February 4, 2026, which was after the January 30th record date for the February dividend. This meant that the newly issued shares did not qualify for the immediate monthly dividend payment, effectively saving the company a one-time dividend outlay on the new capital.
Debt and liquidity position. Following the equity raise, Cardinal aims to maintain a net debt neutral position through the remainder of 2026. As of September 30, 2025, the company's net debt stood at $262 million, with approximately 46% of its $240 million credit facility drawn. The issuance of $105 million in 5-year debentures in early 2025 has also provided structural flexibility by extending the debt maturity profile and providing the liquidity needed to complete REFR 1. Cardinal's $1.2 billion in tax pools represents a significant intangible asset. Under Canadian tax law, these pools can be used to offset taxable income from production. Given the high capital expenditures associated with REFR 1 and 2, Cardinal is effectively creating new tax pools while drawing down existing ones. This positioning suggests that Cardinal will remain a non-cash taxpayer for the foreseeable future, maximizing the cash available for dividends and debt reduction. Production guidance and 2026 outlook. Cardinal's 2026 production guidance reflects a 15% year-over-year increase, driven primarily by the full-year contribution of REFR 1. The company forecasts average annual production of 25,000 to 25,500 BOED. Product mix evolution. The corporate production mix is shifting significantly toward heavy oil as the thermal unit scales. In Q4 2025, heavy oil represented 46% of production. For the full year 2026, this is budgeted to rise to 54%. Conversely, light and medium crude oil weighting is expected to decline from 46% to 35%. Cardinal's 2026 budget is anchored on a US 60 WTI price environment. Under these assumptions, the company expects to generate approximately $208 million in adjusted funds flow and $133 million in free cash flow before REFR 2 incremental capital. The budget is highly sensitive to oil prices, with Cardinal estimating an $11 million impact on AFF for every $1 per barrel change in WTI.
The role of TMEP and Asian exports. The Trans Mountain Expansion Project, TMEP, has fundamentally changed the market for Canadian heavy oil. By Nov 2025, Canadian exports to non-US markets, primarily Asia, reached 549,000 BPD, up from just 112,000 BPD in early 2024. This tidewater access is critical for Cardinal as it scales its thermal production, as it reduces the company's reliance on US Midwest refiners and provides a floor for WCS pricing. Domestic political shifts. The Canadian federal election in April 2025 resulted in a shift toward a more energy-supportive policy environment under Prime Minister Mark Carney. The new administration has emphasized responsible resource extraction and is moving away from the more aggressive anti-hydrocarbon stances of the past decade. This shift is particularly beneficial for long-term projects like REFR 2, as it provides a more stable regulatory framework for the 20-year operating life of the assets. Balance sheet strength. Cardinal's debt-to-equity ratio of 0.24x is among the strongest in its peer group. This balance sheet strength is what allowed the company to obtain favorable terms for its 2025 debenture issuance and its 2026 equity offering. In a volatile price environment, the health score of Cardinal, often ranked 4.6 or higher by analysts, provides a significant margin of safety. Key risk factors. WTI price sensitivity. A minus $1 per barrel change in WTI results in an $11 million decrease in adjusted funds flow, AFF. Mitigation includes the use of low-decline assets and hedging. WCS differential sensitivity. A plus $1 per barrel change in the differential results in an estimated $5 million to $7 million decrease in AFF. Mitigation includes tidewater access via TMEP and Asian exports. Interest rate risk. A plus 1% increase in rates has a moderate impact on floating debt, mitigated by $105 million in fixed-rate debentures. Execution risk. A 6-month delay at Reefer 2 would postpone approximately $50 million to $70 million in forecasted free cash flow. Mitigation includes modular construction and learnings from Reefer 1.
Conclusion. The bull case is powerful because it offers a clear path to high-margin, sustainable production that can support a peer-leading dividend for decades. For investors who believe that the heavy oil market will remain balanced by TMEP and Asian demand, Cardinal represents a high-yield, low-decline vehicle for that thesis. The bear case provides a necessary check on optimism. The recent dilution and the heavy capital spend in 2026 place a burden on the balance sheet, and any significant drop in oil prices could put the dividend in jeopardy. Furthermore, the stock's PE premium means that there is very little room for operational failure at Reefer 2.